Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA Enraja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice, had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executive. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. I received this query: what is the difference between depreciation reserve and accumulated depreciation? I'll just take you through a small journey. Please pay attention. Here I'm going to draw a balance sheet. I am bringing in capital, let's say capital of 10 crore. I'm going to use that capital for purchasing plant and machinery of 10 crore. And I use this plant and machinery so effectively, so I was able to make some sales. So let me prepare my P&L account also here. In the first year, I was able to achieve, let's say, sales of 5 crore. And for achieving the sales, I have incurred some expenses, let's say expense of 1 crore. Now, if I compare the sales with expense 5 crore with 1 crore, I will get a feeling that I have a profit of 4 crore. But we have company law, we have Income Tax Act, which says we have to provide for depreciation. And we know why depreciation is provided. It's basically to capture the wear and tear. It's basically to account for the matching expense when you earn an income. Okay, the matching concept says. Okay, by following this depreciation rules and regulations, I'm going to provide some depreciation. Let's say the useful life of this plant and machinery is 5 years. So I'm going to provide depreciation of 2 crore. So what will happen now? My sales is 5 crore, expense is 1 crore. I was carrying the belief that my profit is 4 crore. I was thinking like I can declare the entire 4 crore as dividend, but no, now there is an expense in the name of depreciation. So my total expense is 3 crore, sales is 5 crore. So what happened to my profit? It is not 4 crore, it has come down because my income is 5 crore. My expenses are 3 crore, so the balancing figure 2 crore is the profit, and it's only this profit that can be declared as dividend. So what I'm going to do is I'm going to declare this entire profit. If I declare this entire profit, what will happen? Nothing will be available for retention. Okay, so let me declare that. So from this profit of 2 crore, I'm going to declare and distribute dividend of 2 crore. So entire 2 crore is distributed. So nothing is left for, or nothing is left in the name of retained profit. So here retained profit is equal to 0. Now let me also just track my cash flow movement. Look at the cash flow. Capital came in. When capital came in, I had 10 crore. Then I used that capital for purchasing plant and machinery, 10 crore. So entire cash gone. Then I have made a sales of 5 crore. For that I have incurred expenses of 1 crore. So 5 crore cash came in, sales 5 crore, and for that I incurred expense of 1 crore. So 0 plus 5 minus 1, I still have 4 crore. This depreciation is not a cash outflow, so I need not deduct that. It means I have cash of 4 crore. But of the cash 4 crore, if I had calculated in the traditional method, I would have concluded this 4 crore is the profit. But no, because of depreciation, thanks to that provision, I'm not going to declare entire 4 crore. I'm going to declare and distribute only 2 crore as a dividend. So from this, Let me pay dividend also 2 crore. So what is left over now? 2 crore. So this is the cash balance. Okay, this is the cash available. Now let's see what will happen to this balance sheet. With this capital, whether any profits can be added, retained profit, no, zero, because entire profits are distributed. What will happen to this plant and machinery? See, already we have accounted for depreciation 2 crore. So from this plant and machinery, we have to deduct depreciation 2 crore. So now it becomes 8 crore. And with this, we can add the cash balance available, which is 2 crore. Cash available 2 crore. Okay. So in this way, 8 plus 2, 10. 10 both sides. Balance sheet tallies. Now observe this very carefully. If I just concluded that profit is 4 crore by comparing the sales and expenses, I would have had a profit of 4 crore. Okay. If I just compare the sales and expenses, 5 minus 1, I would have had the profit as 4 crore. I would have distributed entire 4 crore. Okay. But here, thanks to this depreciation accounting, my profit got reduced to 2 crore and I distributed only 2 crore as dividend. Okay, so nothing is left over. But what happened on the other side? The plant and machinery value reduced by 2 crore in the name of depreciation, but on the other side, cash balance increased by 2 crore. Okay. So there is a reduction in the value of asset, depreciation 2 crore, and there is a cash balance available 2 crore. Now this is only the first year position. Second year, what will happen? If I assume the same figures, what will happen in the second year? Again, another depreciation of 2 crore will be provided, and that 2 crore will get added with this depreciation balance. So in depreciation, already you have 2 crore. With that, another 2 crore will be added. Okay, and this depreciation will become 4 crore because this is basically accumulated position. And what will be the reduced value of the asset now? 10 crore minus 4 crore, it will become 6 crore. But in the next year also there will be another 2 crore cash made available. So what will happen to the cash balance? Cash balance already 2, we are making another 2. So cash balance will become 4 crore. In the same way, if we repeat this for all the 5 years, what will happen eventually is this depreciation every year 2 crore for 5 years, 2 into 5, 10 crore we will be providing in the name of depreciation. So what will happen to the value of plant and machinery now? 10 minus 10, it becomes 0. But on the other side, we will have 2 plus 2 plus 2 plus 2 plus 2. That is 5 years. 5 years cash retained thanks to depreciation accounting. Here we will have 10 crore. Now if you see 10 minus 10, the value of plant and machinery has become 0. But on the other side, you will have cash of 10 crore. So you can use this cash for replacing the plant and machinery. Replacement. Okay. It's actually for this purpose depreciation is provided. It's actually for this purpose this accumulated depreciation is accounted, and on the other side cash will get retained in the business for replacement. Okay. But most of the time all this happens only in air, or it is as good as writing them in water. The reason is whatever you provide as depreciation, and because of that profits get restricted, it means cash balance will be available. To that extent it's fair. But whether this cash balance of 2 crore will it be retained every year for all the 5 years to facilitate the replacement of the asset at the end of the 5th year? That is a $1 million question. Because the moment they retain some cash or the moment they see some cash, it will have n number of requirements. Okay. In reality, it will not happen in the way I explained. Because what did I said? Whatever the depreciation that is provided, that is reflecting in the form of a cash balance on the other side.
and that cash balance will be saved year after year after year for 5 years, and it will be made available for replacement. But companies are not going to save, the business are not going to save. That's where problem comes. But some companies, they want to take this exercise very religiously, very systematically, because they are concerned about their future as well. Not only the present, they are also concerned about their future. So it's those companies which will go for depreciation reserve fund. Okay, it's very similar to the accumulated depreciation. See, in accumulated depreciation, what happens? You are giving one effect in P&L. Let me highlight. You are giving one effect in P&L. Okay. You are giving another effect in depreciation. So year after year you are providing in P&L, and that gets accumulated, but there is no tracking or control over the cash that is made available from depreciation. Okay. So in accumulated depreciation, they just pass an entry in P&L on one side, and on the other side it will be accumulated in balance sheet, and in financial statements it will be presented by deducting it from the fixed assets. But no care is taken to safeguard or preserve this cash. But on the other side, the companies which are going for a depreciation reserve fund, do you know what they will do? They will debit P&L on one side, and on the other side, instead of calling it as accumulated depreciation, they will call it as depreciation reserve, and whatever the cash they set aside, which they got by debiting in the form of depreciation, they will not simply keep it as cash. Rather, they will invest in a kind of sinking fund or some other investment, such a way that that investment matures when the old plant and machinery or the asset retires. Okay, and that maturity amount will be available for replacement. Are you getting me? So it's in this aspect this depreciation reserve and accumulated depreciation differs. Most of the web searches, if you look at it, it will say that accumulated depreciation and depreciation reserve are one and the same. Yes, but the final purpose, there is a difference. In accumulated depreciation, you debit the P&L, you create accumulated depreciation, you show it as a deduction from fixed asset, and you do not bother about what you are going to do with the cash that got into the system, that got retained into the system as a result of depreciation. Whereas in depreciation reserve fund, what you do is you debit the P&L, you create the depreciation reserve. This happens on one side, and on the other side you ensure the cash what is retained is not just left just like that. Rather, they are invested in a fund in such a way that when the existing asset retires, this fund will mature and that money will be available for replacement. So it is in that context these two actually differs. I hope this answers or this clarifies your query.
So much, we have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. I have published several courses on banking and financial analysis area, each course costing 2,000 rupees. But for you, I'm going to give you a special offer.
Here we go. Banking credit courses bundle. This includes course number 1, banking credit analysis process. It's a comprehensive course with 200 plus lectures. It covers financial analysis, working capital, term loan, LC, BG. It's a comprehensive ever course. Then we have course number 2, that is how to carry out financial analysis as a banker. This is going to focus exclusively on financial ratio analysis, cash flow analysis, and fund flow analysis. Then comes course number 3, how to carry out term loan appraisal and analysis as a banker. It's a comprehensive course focusing on the technical aspects around project finance and term loan. These are all the topics. Then comes course number 4, how to prepare CMA report for bank loan through 8 sections. This course will take you through entire CMA report preparation process for bank loans. Then we have course number 5, how to read balance sheet. So if you are a non-finance person, this course will give you complete insight into balance sheet, how to read them, how to interpret them, how to analyze them. Okay. Then we have course number 6, how to read CIBIL report. By taking this course, you will get a complete picture of CIBIL report reading process. Then we have course number 7, how to prepare cash budget for bank loans. This course will help you to understand the concept of cash budget, which is widely used in short-term lending like auto credit facilities, letter of credit and all. So far I have introduced 7 courses of 1,999 each. It means 7 courses of value 13,993, but you are going to get it only for 2,599, and it is not yet over. I'm going to give you some more bonus. Course number 8, collateral securities, a comprehensive study. Course 9, how to carry out credit risk rating for non-trading entities. Course number 10, in this course you will learn banking credit analysis through various case studies. So now it is 10 courses of value close to 20,000, but you are going to pay only 2,599. It is not yet over, some more bonus. Course number 11, how to read audit report. Course 12, this focuses on letter of credit, and course 13 focuses on financial analysis in very short duration. So you have 13 courses of value close to 26,000 rupees, but you are going to get it for just 2,599. So it is basically 7 main courses, and you are going to get another 6 complimentary courses, 6 courses as bonus. So overall it is 13 courses of value close to 26,000 rupees. It's 1,500 plus lectures. You get lifetime access for all these pre-recorded courses. You can access them in desktop, laptop, mobile, iPhone, iPad, and the overall cost is around 26,000, but you are going to get it only for 2,599. So this is a once in a time opportunity for you. Enroll now. I'll see you inside the course.